We're privileged to hear next from Nick Singhvi. Nick is with the Federal Trade Commission with the Division of Financial Practices in the Bureau of Consumer Protection. Say that's a mouthful. But Nick is kind of the guy at the FTC that is responsible for looking after our marketplace. So we wanted to have Nick come and give everybody a rundown of some of the things that the FTC is working on as it relates to our space. So without further ado, let me turn it over to Nick.
All right, well, thank you, Sean, for that nice introduction and for the NIADA for having me here. So what I'd like to do is, you've heard a little bit about me. I'd like to hear a little bit about you. By that I mean, I'm assuming that we have dealers in the audience and non-dealers in the audience, folks like financing companies or maybe insurance providers, other kinds of vendors. So just so I can get a sense by show of hands, how many non-dealers do we have out here? Okay. And the rest are dealers? Another show of hands? Yeah? All right. Well, that's also important because I have an assistant in the back who's going to be handing out subpoenas depending on which role you... No, that's not true. That's why I have this up there while I give that stupid joke. But it is important to let you know that the written and oral views expressed in this presentation do not necessarily reflect the views of the Commission or any individual commissioner. I will also note that this disclaimer that I've given to you is clear and conspicuous, and we'll come back to that term later. Someone's already laughing. All right, great. So in our limited time today, I want to talk about compliance in sales and financing, and I want to take it from the perspective of the buyer. The reason I want to do this is there's a lot of facts that you're probably aware of, but it's useful to use them as a starting out point, which is that the car buying purchase is the first or second most expensive purchase in the consumer's life. It can be an exhausting transaction that lasts 2 or more hours. And on a micro level, there's a great information and experience asymmetry. And by that I mean a consumer is likely to buy 5 or 6 cars in her life. The dealers in the room may be selling 5 or 6 cars or more every day. And at a macro level, it's of vital importance to the economy, as there is, on the aggregate, Americans owe more than $1 trillion in car debt. So what I'd like to do is talk about 5 stages of the purchase process that we at the FTC are most interested in. So first is advertising, how the consumers wind up in your showrooms in the first place. Pricing. We'll get into a little bit all the different pricing terms that consumers are exposed to and some of the confusion that results from that. Financing. So after the consumer has selected a car and agreed on a price, they typically go into the F&I office, and we'll talk about some issues that can arise in that context. Add-ons. Again, this is for after the financing. Usually we are pitching insurance products or other products and services that are offered by the dealer, not by the manufacturer. And then we move to paperwork and delivery, where if everything goes well, the consumer will go home with the car. On the other side of the screen, I'm going to start listing the statutes and rules that we're most interested in. Not necessarily in order of importance, but the things that we work on at the Federal Trade Commission. First of all, the Truth in Lending Act, which governs disclosures, and in limited cases, advertising also for financing transactions. The parallel is the Consumer Leasing Act, which has very similar requirements for lease transactions. ECOA, which governs fair lending practices. The FCRA, which governs credit reporting. And the FTC Act, which is our general prohibition on deceptive acts and practices. And then, of course, we have FTC rules, some of which include the used car rule, privacy rule, which implements the GLB Act for financial privacy, and we also have the Mag-Moss Act, which deals with warranty information. Now, at the center of the Federal Trade Commission, well, what do? Well, first thing we do, one of the things is law enforcement. We've brought 40 cases in the last 10 years, 45-ish cases in the last 10 years, And we'll get into some of the groupings of cases and the kinds of issues that come up most often. We also do consumer and business education via web blogs and videos. We do workshops and roundtables, and we speak at conferences like this one. And we coordinate with other federal and state law enforcement, as you heard Director Kreninger just talking about. Of course, we work very closely with the CFPB and also with the states. So I want to take each of those stages in turn and talk about some of the issues we're seeing and some of the expectations that we have. And then after we go through those stages, get into some concrete examples of enforcement cases that we've brought in the space. So first, with respect to advertising, it starts out pretty simply. Do not make false or misleading claims. We've seen a number of problematic practices in this area, starting out with the price, discounts and rebates, financing offers, and vehicle safety. If disclaimers are necessary to add detail to a claim, they cannot contradict the original message, and they should be clear and conspicuous. So clear meaning in language that consumers can understand, conspicuous meaning in language that, or in a place where consumers will find it. And of course, that also applies online, it applies in social media, it applies on the radio, and it applies on television. And we'll see in our enforcement examples some places where those principles have been violated. I mentioned briefly on the previous slide TILA and the CLA. In the advertising space, there are necessary disclosures for certain terms that apply to financing transactions and leasing transactions when other quote-unquote triggering terms are used. So most often that means if you are disclosing a down payment amount, you must also disclose the APR, the monthly payment, and the term of the loan. So price. There are a lot of different terms being used at dealerships for price, and we think we have a handle on them at the FTC, but I'll tick through them at least to show you what our understanding is, with the caveat that we hear from consumers all the time, and they are really very confused about these different terms. First, we have the invoice, which is the amount that the manufacturer charges the dealer. We have the base price, which is the cost of car without options. This is sometimes found on the sticker. We also have the Monroney sticker price, which is the base price plus the options installed by the manufacturers and perhaps a transportation charge. We have the dealer sticker price, which is the Monroney sticker price plus the dealer installed options. We have the out-the-door price, which is the total price plus the taxes, fees, and doc prep charges, but usually does not include the financing. And then the total sales price would be all the above with the financing. This, again, is a big source of confusion for consumers, and our hope is that the dealers in the room are doing a good job in explaining to consumers at each stage what price they think, what price is being discussed. Because a lot of times we're finding that consumers are confused and frustrated when additional prices, additional charges are being added on later in the process. Speaking of which, financing. So after the consumer has chosen a car and agreed to terms, at least as for a sales price, they have a discussion, usually in the F&I office, and this is where I think probably the adrenaline of choosing a car starts to wane and some of the fatigue will set in. One particular problem here is the focus on the monthly price, and that creates additional vulnerability and confusion for consumers. A more problematic issue here is a lot of times consumers are reporting that they are expecting to get certain financing terms, or they're expecting to get certain discounts or rebates, and they go into the F&I office and those start to disappear. And that is either the result of some miscommunication or misunderstanding, but it is a common phenomenon, and it's something that we're interested in eliminating, frankly. And hopefully that's via better education or better communication, but as I mentioned, it is an issue that is coming up. Another even more pernicious problem is when consumers are told that their underwater car will, that the dealer is going to pay off their car, when in fact the cost of exiting that loan is going to be rolled into the financing for the new car. Of course, consumers can choose to do this. The issue is that if they are promised that it is going to be paid by the dealer when in fact it is being paid by the consumer via a higher monthly payment or otherwise baked into the financing. Then we have the next stage, which is the add-ons. Again, this is coming in late in the process. So this is after a discussion about the car, after sales price, after financing in many cases. And some of the issues we're seeing here are some of the products pitched at this stage don't really have to do with financing. And it leaves people wondering why they weren't talking about this earlier in the process. Again, more pernicious conduct here is we're seeing, and we brought cases where these add-ons are being added into the contract without the consumer's authorization, or they're being falsely described as free. They could also be falsely described as required when in fact they're not. And there may be just general deception as to the quality, the features, the limitations of these products. We see consumer complaints about that also. And then with respect to pricing, again, a focus on a monthly price as opposed to a total price, both with the car and with respect to add-on products and services, can create confusion where the consumer is thinking about something as a monthly cost. And in this example, in the case of a 6-year term, $15 a month might not sound like very much, but it is $1,080 over the course of the loan, and that's not even counting the interest on that purchase. Next, we were talking about paperwork, signing, and delivery. And if I get repetitive, please forgive me, but this is also an issue where fatigue comes in, because now we're talking about, after a discussion about the car, after a discussion about the sales price, the financing, and the add-ons, we have sometimes a stack full of papers for the consumers to sign. They're sometimes urged to rush through this paperwork, and they're overwhelmed by the volume. In some cases, consumers are urged to sign and leave items blank. And then we have the separate but related issue of spot delivery, where the consumer is told that he may drive off the car with the lot, that the assignee, the financing company, will be reviewing the papers, and that the sale is contingent. There's some problems that we see with this practice that consumers are reporting. First is that the consumer is not told that the financing is contingent, or that the consumer is misled into thinking that the consumer also has the right to back out, which is almost never the case. And then in the worst case, what we call a yo-yo, is when the consumer is brought back to the dealership, told that the financing was not approved, and then forced into a materially worse financing deal, told that it's required, told that if they brought in a trade, that the trade has already been disposed of, that their down payment is going to be forfeited. There's a lot of vulnerability for consumers when they come back on account of a spot delivery that is recalled. So now I want to get into some enforcement examples that will maybe bring some of these concepts into greater focus. And I'll start with some general sweeps that we've brought, and then get into very specific cases. So Operation Steer Clear from several years ago were basically 10 auto cases that concentrated on deceptive auto advertising. We also had Operation Ruse Control. This is a really great example of coordination with the federal government and the states. There was, in all, more than 250 actions brought in this country and in Canada, and you can see the types of misconduct that were at issue there. And then more recently, the most recent sweep was the recall sweep, and this involved claims that regarding the safety of vehicles and safety inspections of vehicles, when in fact many of the vehicles being touted were subject to open recalls, which had not been satisfied. Now, because no doubt you are tired of hearing my voice, I'm going to play for you an advertisement. And this is from a case we brought against Kia Sportage. And as you're watching the advertisement, I'd like you to think about what you think the monthly payments for the advertised vehicle will be.
I'm Nick.
And I'm Abby.
Paramount Kia Asheville.
It's the final countdown to savings. Now is the best time to buy. Don't wait. Tomorrow may be too late. Drive any vehicle like the new 2013 Kia Sportage. $0 down, $99 a month.
Push, pull, or drag it. We'll trade for anything.
It's the same as cash. We have a huge selection to choose from. And if you're worried about your credit, don't sweat it.
We say yes. We do it every day.
Every day, right here at Paramount Kia Asheville. 2 locations, Biltmore Square Mile and Tunnel Road, where
we say yes.
It looks and sounds very much like a $99 a month with $0 down. It is not $99 a month with $0 down. In fact, it's $99 for 3 months and then $531 for the next 69 months. It's also not $0 down because there's a $599 administrative fee. The woman in the ad said any vehicle. In fact, it applies only to select vehicles. When we look at the next slide, this is a screenshot of about 2 to 3 seconds where there's some text over the wheel I'll get to in a second, but this is the main claim, $0 down and $99 a month. Note that next to the $99 a month, that claim is completely unqualified. There is no asterisk or any hint that the fine print almost entirely negates the claim. Of course, given that it's only valid for 3 months and that the terms for the next 69 months are so materially different, you would need a pretty large disclosure here. And what we'll get to, the text surrounding the wheel, the front wheel, that even if it were legible would be a huge problem, but we don't even get there because it's white text over the silver wheel, over the beige khakis. A consumer watching this on television has got no idea what that says, not going to be able to read it. And of course, and I mentioned before, it's available only for 2 to 3 seconds. So this is an example of a particularly bad video advertisement, and we'll next get into some print advertisements. This example is from the Southwest Kia case. And by the way, this is nothing against Kia in particular, it's just a coincidence. In any event, the monthly costs here are grossly understated because some of these cars have a 38th month payment of more than $8,000. They also have initial payments of up to $2,000. Now, I was trying to be fair with this presentation of the fine print. This is actually to scale. If you had this in front of you, you would not be able to read it without magnification. This particular dealer was a repeat offender. So in the FTC parlance, that is an order violation. It resulted in an $80,000 penalty. I don't have a slide for you today on Norm Reeves Ford, but that is a similar matter where, again, it was a repeat offender, and the penalty in that case was $1.4 million. This is from the Cowboy Toyota case. I promise you'd we'd mention something other than a Kia. So here we have a very similar problem with prominent terms that are completely reversed by inconspicuous fine print, with the additional issue here that the body of the ad is in Spanish and the fine print is in English. There's another wrinkle here, which is that the offers appear to be for sales. In fact, they're for leases. And other parts of the ad not pictured here were touted as available to people with bad credit, when in fact the disclaimer said that they were for TFS Tier 1 Plus, which is very good or excellent credit. So this is an example of another example of deception with fine print on slightly different facts. Sage Auto is a case we brought about 2 years ago, and its claim to fame is the yo-yo financing that I spoke about a little bit before. Again, this is where the consumer drives off the lot, financing is not finalized, and the consumer is called back. In Sage, we alleged that the consumers had been coerced into accepting less favorable terms. That included paying more money down, making higher monthly payments. Consumers, we alleged, were told that they were required to sign new agreements, but of course they were not required to do so. We alleged that consumers were told that their trade-in or down payment would be forfeited, which the dealers could not do. Or we claimed that the consumers had been told that that their cars would be repossessed, they would get sued, or they would be arrested. There was also issues with the online reviews at Sage Auto, including fake consumer reviews posted by employees or their relatives. There was the bait and switch advertising that I talked about before with respect to financing terms or trade-in values, none of which were actually available. We alleged problems with add-ons, and those included that add-ons were inserted into contracts without consumers' knowledge. Consumers were told that add-ons could be refunded after a trial period, but the dealer did not honor the refund requests. Consumers were told that add-ons were necessary for financing, but they were not. And also, in some cases, just the terms of the add-ons were misrepresented. They were told that they would get free lifetime servicing, but then they were charged for oil changes and the like. This was as you could tell, this is a large monetary settlement and also included individual liability. And for those of you who follow our change in leadership at the FTC, these are really big points of emphasis for our relatively new slate of commissioners. And by that I mean emphasis on money judgments and on individual liability. The latter of which also plays into a pending case that we're bringing in Arizona called Tate's Auto. And this is important because it's our first case where we allege that dealers are misrepresenting consumers' income information and down payment information in the financing that's submitted to the financing companies or the assignees. And that is putting consumers into cars that they otherwise would not be qualified for, and it's resulting in early payment defaults at much higher than expected rates. To accomplish this fraud, we allege that consumers were rushed through the paperwork and urged to sign blank forms. We also have advertising claims of the sort that we've talked about before. And in Tate's Auto, we have the TILA and CLA violations, including the one that's excerpted here, which is a Facebook ad. It talks about a monthly payment and a down payment, but it does not have information about the APR. And that is in the case of a sale financing, that's a TILA violation, or if it's a lease, then it's a CLA violation. But the point here, again, in addition to the fraudulent financing applications, is the social media advertising. I believe it's our first auto case challenging social media advertising. National Payment Center is an interesting case we brought for basically a payment vendor whose pitch to consumers, although I should say the dealers were making the pitch to consumers, was that if you pay via biweekly payments instead of monthly payments, you can pay off your loan faster and save money. The problem with this plan was that, this pitch materials were given to the dealers, not to the consumers. In the fine print below was a disclosure that the fees charged to borrowers may exceed the interest savings. The fees were $399 to enroll and $2 to $3 per payment. So depending on the loan, the fees could erase all the savings from the program or even cost the consumer more than the consumer would otherwise pay. And the enrollment fee and the fee per payment were not disclosed to the consumers in any pitch materials. And the materials that we've excerpted here, which went to the dealers, they were in the fine print. And there was no means to verify that that information was being clearly or at all presented to consumers. National Payment Center incentivized dealers to enroll consumers in this via sharing of the enrollment proceeds. And so we brought cases both against National Payment Center and one of the dealers that offered its product, resulting in $2.5 million in consumer refunds. So I don't want to end on all those sour notes. I do want to offer some advice and counsel for the folks in the room, and that is via our website. If you visit business.ftc.gov and follow the links for selected industries and automobiles, you'll see some what I think are helpful materials specifically for this audience. Those include advertising FAQs, which are granted a little bit generalized, as are the .com disclosures, which will help in the online advertising, and then some of the rules and statutes that apply very specifically to the auto market. And those are a really good place to start when you're designing your advertising and thinking about the other compliance issues that are present at the FTC. I do want to conclude with some thoughts about what we covered today. Of course, advertising must be truthful. Financing applications must be accurate. We saw that in the Tate's case. And we're really hoping that consumers are going to have time in the dealerships to make informed decision about financing and add-ons. So I think my time is near an end, so I'll let...
Anybody have a couple questions for Nick, maybe? Are you up for questions? Dan front, and then Yola.
Hi, thanks for coming. Quick question, two of them. Spot delivery and yo-yo, do those go hand in hand a lot of times, I would assume? And then in regards to pricing, when people like the Facebook with, I think it was Tito's or something you had there, does as low as, is it a CYA thing, or does it actually protect a dealer if they put payments as low as, but not specific everything else?
Okay, so yo-yos can only happen when spot deliveries, but not all spot deliveries result in yo-yos. I don't mean to be cute about it, but I think that's the way I think of it. So I don't think that we have an issue with spot deliveries per se. What we want is for consumers to understand what the conditions are. What are their rights if they're called back? Are there usage fees? Are they going to get their trade-in back? Are they going to get their down payment back? They should just understand that it's contingent and that they can call back. Yo-yos are never okay, the way we define it, and that is coercing the consumer into a different deal after he or she is called back. On the advertisement, I think we could be here for an hour talking about as low as or up to claims. Until recently, I taught a class at George Mason, and we touched on this. The most important thing with things like that, I think, is record keeping. That if you have advertisements that are up to or have specific offers, rebates, discounts, that upon challenge, if a lot of consumers complain about it, it would be helpful to see that sales were made at that price, that some consumers were able to redeem that discount, redeem that rebate. And when we ask questions like, well, what is the substantiation for that claim, a really good piece of evidence would be, yes, we have some number of consumers who actually paid this price. We have some number of consumers who actually got that discount.
Hi, good afternoon. I'm wondering if the FTC is watching third-party advertising platforms. I actually have a packet for you. I'm going to give it to you afterwards. I'm prepared this time. But we have a big issue. It's in the state of Florida in particular. I don't know about my fellow dealers, where we have deceptive advertisers on, say, CarGurus, Cars.com, Auto Trader, and they'll have a price, but then either it's not disclosed at all on that website, or on the CarGurus, and you have to go back to the dealer's website, and buried in the fine print, these dealers are charging $1,200. I have one in here that's we think is over $5,000. And it's misleading the consumers because they're using a brand like CarGurus, and they're saying, okay, I trust this brand, and then CarGurus is saying, hey, consumer, this is a great deal. It's $2,900 and fair market value, when in fact that car is $5,000 more. Is the FTC watching this at all? Because it's really hurting a lot of us in the industry who are doing the right thing.
I think I'll answer it this way. We follow consumer complaints, that's number one. We don't restrict our review of advertising to first-party dealer advertising. So if we see, and I'll just broaden it out a little bit past auto. There are a lot of examples where we go after, I'm not saying that this is actually a lead gen model, but there are times where we go after lead generators for advertising and they're not actually providing the product. So, and other dealers in other conferences that my colleagues have spoken of raised this same issue as you have, which is you're observing that other folks are making deceptive advertising and you're feeling like you're put at a disadvantage because you're conscientiously following the rules. So I will tell you that it's something that we're looking at and we're looking at closely, and we don't restrict our review to first-party ads.
Thanks for coming, appreciate that. I have a question. Can you speak to the FTCs and looking at as we go fast forward into a digital industry, how auto sales and online sales are gonna work out from your view?
So I think there's a learning curve on all industries as they change it. Maybe, and I don't mean this in a negative way, but maybe auto is a little bit slower than other places like lending, consumer lending. But we are interested in the different kind of consumer experience. Nowadays, in limited cases, consumers can go through the entire experience online, and we are interested in what their experience is like, and I think we just apply general FTC principles about how claims are made, how they're understood, what websites look like. Before I took on, I analogized to consumer lending because that was my responsibility before I took on this one for auto, and I still work on consumer lending cases. And there was a time not long ago when people got loans in banks, and now people get loans online. And we remain as active as we can, and we try to analyze all transactions from the consumer's point of view. And if consumers are increasingly going online, not just to shop for cars, but to complete transactions, then we're definitely going to be looking at that process also.
Any last questions before we send Nick out the door? All right, well, let's give Nick a big round of applause. Thank you for his time.
Thank you, guys. Thank you, everyone.